Hello traders, Steve Ganz here. I want to share another thought with you. This is on assignment. I get a lot of questions, particularly if you're trading stock, ETF, etc., about assignment, and people are afraid of or freaked out over the possibility of getting assigned. I want to share with you a scenario and just kind of how assignment works and how assignment is largely a non-issue. It's not something to be feared. And let me show you two different scenarios. So the scenario that I'm going to outline here, and I think this will be a really good topic, and if you like the topic, please make sure that you like, subscribe, maybe give me a comment down there. So here's the premise. I put the premise up here in this cell. So I am going to sell an at-the-money $5 wide put credit spread. In this case, I'm going to sell the 440, buy the 435. Of course, that gives me this general profile. I'm doing this 9 days out in this case. It doesn't make any difference. I'm just trying to set the stage so that when I get into the numbers, you'll see what the numbers are based off of. My premise here is I'm selling this at the money, so the market's trading right around 440. Today it closed at 439.62, so I'm going to call it 440. So the market's trading right here around 440, and then I am making the assumption here for the purposes of this demonstration that at expiration, so 9 days from now, the market is going to be down here at 430. Now, per our diagram, that means that we would be losing $330 in this spread. So let me share with you how that happens. So the first thing we do in the spread, of course, is we go and we sell our initial spread. So we sell this put credit spread. We're selling the 440 here for $3.96. We're buying the 435 for $2.26. So these are the two prices. So we're selling our short put. We're taking in $3.96. We're buying our long put. So we're having to spend $2.26. The net is this $1.70 credit. So that's where this net credit comes in of $170, and that is our max profit. So if the market expires up here somewhere, well, there's no assignment that takes place, and we pocket the $170. That's not the purpose of today's discussion. Today's discussion is going to assume the worst case scenario, which is where our entire spread gets run through. So in the case of a spread, if the price drops down here to 430, what's going to happen at expiration is we are going to have to buy to close this spread, and we're going to buy back our in-the-money short put, and we're going to have to buy that back at $10 because, of course, we're selling the 440 put. The market's going to close at 430. That's a $10 difference, so we're going to have to pay $10, but our long put at 435 is $5 in the money. So the difference between 435 and 430, of course, is $5. So we'll be able to get money for that long put, giving us a net of $5. So it's going to cost us $5, or of course, as we all know when we're talking options, that this is the per share price. This all has to be multiplied times 100. So it's going to cost us $500 to close this spread. Now, we took in $1.70 when we sold it. That is our net loss then of $3.30 if our spread gets entirely run through. Now, let's talk about if we get assigned. So now I'm making the assumption here that if this is a Friday expiration, for example, I'm going to talk about if we get assigned sometime before Friday night. If we get assigned Friday night and this long put is not in existence come Monday when that stock shows up in our account, that's a little bit of a different animal. So I would not ever recommend not closing at least your short strike on the day of expiration. You should always close your short strike. But again, let's just assume any day prior to the expiration day, you get assigned the stock. So what's going to happen here, the first part of this is exactly the same. We're going to sell our short spread, just like we did here. Nothing's going to change. However, we're going to get assigned somewhere. We're going to get assigned stock. So the sale of this short put that we sold for $3.96, that's going to close out at 0. We're going to get full value for that, but we're going to have stock tossed at us to the tune of $440. We're going to have to pay out $440 for that. Now, the market totally tanked. Again, we're down here at $430. We're going to close this position out. So we sell our stock at $430. So we were forced to buy it at $440. We're going to sell it at $430. That long put, this long put right here, the $435, that's still going to have a $5 value to it. So we get that as well. So when we add all of this up, the sale of the assigned stock, the difference between this, okay, so we had a $10 loss per share on our stock. We had a $3.96 profit on our short put, because again, when we were assigned, that essentially zeroed out. That means that it was worth 0, or it automatically gets assigned a value of 0 when you get the stock assigned to you. So we got full price, full value, full profit on that. And then our long put P&L. We were able to sell that long put for $5. Again, originally we purchased it for $2.26. So that difference gives us $2.74. If we add all three of these up, it comes out to the same, $3.30. So it's the exact same loss whether you got assigned or didn't get assigned. Again, making the assumption, there's so many variables in here, but this is how you would calculate this. So I'm just showing it at expiration. Of course, if you get assigned in the middle here, it's going to have different ramifications, etc. But at the end of the day, at expiration, whether you got assigned and then you sold your stock and you sold that long put, or whether you got assigned in the middle here, doesn't make any difference. The position is, for all practical purposes, exactly the same position, with the exception of course, when you get assigned, you have to buy 100 shares at $440 per. That's $44,000. So that's the part that freaks everyone out. However, the way most brokers do it, and I urge you to contact your broker and ask them about this, what they will do is they'll put that stock to you at $44,000, and then they will, if you don't have that money in your account to cover that very same day that they assign you, they will give you what's called a margin call. They'll basically give you a notice that says, hey, you bought more stuff than you had money in your account to pay for. You bought something that was too rich for your blood at this point. And all you need to do is just go in and sell it. Just go in and liquidate that stock at that point. And at the same time, you can close out that long put, essentially shutting down the trade. So it's not going to impact you any more negatively. And again, different brokers do things a little bit different, but the core premise is the same. Now, what a broker might do if you don't close it that day, maybe some brokers even charge you during the day. They may charge you a small amount of interest because they're essentially having to loan you that money. until you close the position. Now, at most brokers, that doesn't kick in unless you don't close the position during that particular day that you were assigned. In most cases, my understanding is if you close the position during the day that you were assigned, they're not really charging you interest on that, and there's no penalty or anything else. It is scary to hear margin call, okay? I get that. But at the end of the day, the position is the same. Now, I'm going to pause here for just a second, and I'm going to set something up to help illustrate this a little bit further in options. All right, so now to illustrate this process to you in OptionStrat, again, I've got this exact same spread on. I sold the 440, bought the 435. You can see my maximum risk here is 330. My maximum profit is 170. So let's just say now that I get assigned. Well, if I get assigned, two things happen. One, I get 100 long shares put to me at my price of 440. So I need to now include that in my P&L diagram. But at the same time, this short put gets closed out. So this thing essentially gets bought back. Let's see, I got to close that position. And buy to close, I'm going to pay 0 for it. Okay. So we're going to buy to close that for 0. And you can see my diagram is exactly the same. My risk is still $330. The only real difference is I now have an upside ramp that if the market were to all of a sudden rip back up to the upside a huge amount, you know, yeehaw, I've got a nice profit. But again, keep in mind that assignment isn't going to happen until usually the last few days that you're in a position, and you're not going to get a massive move like this usually within the last day or two. So I certainly wouldn't expect to benefit from this particular aspect of this trade. The key point that I want to share here is that your risk is no higher once you got assigned, once you have 100 shares of stock, because this long put offsets it. And the more the market goes down all the way to 400, you're going to lose a massive amount in the long shares. You're going to lose $4,000 in your long shares of the stock. However, this position is going to gain $3,500 because it's a 435 put. If the market went all the way down to 430, this is going to gain $3,500. Of course, the difference between that being the same $5 cost to close. But again, we sold this whole spread initially for $1.70, which circles us back to the same loss of $330. I know that was a lot of math tossed at you here, but I think it's really important that people understand what happens in the assignment process. And the biggest takeaway that people need to recognize is that when you get assigned these shares, so long as this long put is still in place, your position is exactly the same as it was when you had a 440 short put and the 435 long put. Again, the one important caveat is if this spread expires at the end of a given day, you're going to want to at least make sure that you close out your short trade, your short part of your trade, so that you don't get assigned. If you haven't been assigned yet and the market plummets below your short strike on expiration day, I would close that entire trade out. And then that way you're not going to get assigned and then not have something to cover or insurance on that potential assignment. Again, worst case scenario here would be that you have this spread on going into the close on a Friday, and the market drops down to below 440. You get assigned at 440 over the weekend. Monday morning, the market opens up down at 425. You no longer have this put, this long put, because it expired on Friday too. In that scenario, you will have a sizable loss because you don't have this there to protect you anymore. So again, the basic rule of assignment is don't get assigned on the day of expiration. If you get assigned prior to the day of expiration and your long put is still intact, which it should be, then it's exactly the same as having that original spread on. If you get assigned on the day of expiration and then it shows up in your account the following day, when this no longer exists, then you have significant exposure that you will not want. So hopefully this gives you a little better understanding of of assignment and expiration. And again, nobody really, well, I shouldn't say nobody wants to be assigned. I will often sell naked short puts hoping to get assigned something. I've got a trade out right now called the Wheel in Google, and you can go down and take a look at that. In that particular case, I want to get assigned. I'm going to keep selling short puts on it until I do finally get assigned. But if you're newer to this, and assignment, the concept of assignment might freak you out. But the math here shows that there's really nothing to get freaked out about. It's the exact same position so long as none of this has expired. So if anyone has any questions, also make a note down below, and thanks so much for your time.